the CEO of a computer resale business is expanding. So they want to expand. She is presented with two options under proposal A. The estimated investment for the expansion project is $85,000. It is expected to produce after-tax cash flows of $25,000 for each of the next 6 years. So every year 25,000 they are going to get. Okay, $25,000 inflows every year. Project proposal B involves investment of $32,000 and the after-tax cash flows of $10,000 for the next 6 years. Now they're asking you which two desired rates of return will the CEO be indifferent to either proposal? So what do you think? What shall be done with this? Such kind of question. See, the desired rate of return at which the two projects will produce the same NPV can be found by calculating the IRR of the difference in cash flows between the two projects. So what I'm going to do, see, what is the difference between the investments between A and B? $33,000, right? Is it right or wrong?
Difference 85 and 32.
See, here it is 32, here it is 85.
53 is difference.
5, yeah, it is 60, it's 60. Okay, yeah, just a second, sorry, it is 53, sorry. So the difference is how much?
53,000.
53, right? Yeah. This is the difference in investment and the difference in inflows is of
$15,000.
$15,000. This is for 6 years, right?
Yeah.
So what we'll do is, this is what is relevant for us. The incremental cash outflow is 53,000 and the incremental cash inflow is 15,000, right? So what we will do, we will divide this 53,000 by 15,000. Tell me, what are you getting?
$3.5.
3.533. So if you have your textbook, which I have given to you, you can just search in 6th year in the present value annuity factor, because these are annuity, like, right? Present value annuity factor table, you can go and you can check in 6th year. This 3.533 is lying between which rates? So you will find that these are lying between 16 and 18%. Can you check it and confirm so that we will move forward?
In 16%, 3.685, 18%, 3.498. In between.
Yeah, between. So this is the rate at which they are indifferent. Okay.
Okay.
Now.
I'll note it just.
Oh, okay. You can do it. No problem.
Then.
Yeah. The next question, Tenet company is considering two mutually exclusive projects. That means only one can be selected out of two. Both cannot happen at a time. NPV profiles of the two projects are as follows. Discount rate NPV. So this is at this rate, the NPV is this and this. So it is going on like every time, right? And sorry.
Okay. Hello.
Yeah. Hello. Yes. So like in the sense, what are they asking? They are asking companies considering the NPV profile of two projects are as follows. The discount rates are given, the NPVs are given. The what are they asking? Like what is the question all about? Question number 7, right?
Yes.
Okay. The company president is of the view that project B should be accepted because it has the higher IRR. The president requested John Mack, the CFO, to make a recommendation. The company's cost of capital is 10%, which one of the following options should Mac recommend to the president? See, generally when you want to select some project, and that too which are mutually exclusive, that means one can be selected out of both of them. So NPV is a superior method, am I right?
Yes.
So accept both projects. It can't happen. You can't accept two projects because it is mutually exclusive. Absolutely wrong statement. Accept project A because at a 10% discount rate, it has an NPV that is greater than the project B. Very simply, we can understand that's a true statement, right?
Yes.
So based upon that, I can really select project A. Agree with the president. So what did the president say about B? I won't agree because B's NPV is less than A's NPV, right? At 10%, correct?
Yeah.
IRR is not the criteria based upon which I will be selecting. So the answer is 2.
Okay.
Can you go for this question?
Yes.
Try to give the answer. So a firm is evaluating two projects that are mutually exclusive. Project Alpha has an expected life of 5 years. Project Beta has an expected life of 7 years. Firm's required rate of return is 8% per year in years 1 and 2, 10% in years 3 and 7. Which discounted cash flow method should the firm use to evaluate these projects? IRR because it assumes that project cash flows are reinvested at project's rate of return. Absolutely wrong notion. Why it's a wrong notion? Since the firm knows the required rate of returns here, right? It would be better to use NPV because NPV assumes that the funds are reinvested at required rate of return, right?
Yeah.
Even if that is changing year by year. IRR assumes that it should be reinvested at IRR. Are you understanding?
NPV?
NPV assumes that the like cash flows what you're getting, okay,
Okay.
uh, the funds what you have should be reinvested at required rate of return. Are you
Not
understand?
IRR. Okay.
Not IRR. No, no. NPV. Why NPV will have an assumption of such kind whereby according to the assumption they will be thinking to invest the money at IRR. No way. Okay. NPV is a separate method, different method. NPV method has an assumption that the fund should be reinvested at the project's required rate of return. Okay. IRR thinks that it should be reinvested at IRR, which won't be happening always, right?
Yeah.
So NPV value, net present value, because IRR assumes that project cash flows can be reinvested at IRR. So this is the right statement.
Yes.
And NPV thinks that it should be reinvested at the required rate of return.
Yeah.
So NPV assumes that the fund should be reinvested at required rate of return, and IRR thinks that the fund should be reinvested at IRR, right?
Yeah.
Shall I move forward?
Okay. Yes.
Question number 9. Company is considering the purchase of a machine for $500,000 that will last 5 years. A financial analysis is being developed using the following information. These are the sales minus variable cost gives contribution, less fixed cost gives profit, and they have this pre-tax cash flow, right? So cash flow is relevant for decision making process. So every years, the number of units, how many sold are given, selling price per unit is given, variable cost per unit is given, fixed costs are given. These are always like total amounts, and pre-tax cash flow is given. So now the machine will be depreciated over 5 years on a SLM, straight line basis, for tax purposes. Okay. Company is subject to 40% effective income tax rate. Assuming the company will have significant taxable income from other lines of business and using a 20% discount rate, the NPV will be what they're asking. Can you do this?
Yes. Pre-tax cash flow is equals to PBIT.
Sorry?
Pre-tax cash flow is equal to PBIT.
No. PBIT is different. You have to convert PBIT to cash flows, but need not worry, right? They have given pre-tax cash flow. You can take after-tax cash flows. Finished.
Okay.
That means
20.
you can take 60%, right?
0.6. Okay.
Yeah. Can you try to find out? Shall I wait?
Yes.
Okay.
Hello.
Yes.
After deducting tax rate, we have to do 20% discount rate.
Yes. First, what you have to do, you have to find out the you have to take the after tax cash flows, right?
Yeah.
You have to discount them. You will
Okay.
get the cash
After
discounted
tax.
cash, yeah, discounted cash inflows, right?
Mm.
But is that the only thing here? They have given some information about straight line method. So I
Yeah.
think there again comes the depreciation tax shield, right?
Yes.
So what we will do is, shall I do this?
Yes.
Hello?
Yes, sir.
Yeah, after tax cash flows. So what we can do, we can keep it in this way: 30,000,
30,000.
30,000.
20.
Why I'm getting 30,000 is into 0.60
6. Yes.
to 0.60 into 0.60. It's like
2 lakh 40,000.
2,40,000 year 1, year 2, year 3, year 4, year 5. And like zero is nothing but we have invested. How much is the investment in this project? Did they give investment?
No.
No, they have given now $500,000.
Hmm. 5 lakh.
So again I have to take 240 and 240. So this is what then we can go for tax allowable depreciation cash savings. So what is the equipment value? It is 500,000, right?
Hmm.
And the life is 5 years. So $100,000 is the depreciation. On that, if I take tax rate of 40%, 40,000 is my tax shield, right?
Tax bill. Yes.
Okay. Now, this 40,000 is the fixed amount for every year, right?
Yes.
Hello.
Yes, sir. Hello.
Yeah, this 40,000 is every year, right?
Hmm.
Hello.
Hello. Yes, sir.
Yeah, this 40,000 is the fixed cash flows for coming 5 years, correct?
Yeah.
So the discount factor is 20%. Can you tell me the annuity factor for 5 years?
Annuity factor for 5 years.
Yeah.
5 years, 20%.
This
Hello.
is, yeah, annuity factor at the rate of 20% for 5 years.
2.991.
What did he say? Sorry.
2.991.
Yeah, 2.99. Right. So now what we can do is instead of all this, we can just, yeah, we have to do the discounting also, right? Because I'm taking annuity here.
Mm.
Okay. Like we would have like we can directly take annuity or we can like find put it here also, no problem. Okay.
Okay.
Now what we can do is we can just take the factors. Discount factor at the rate of 20%. Just can you multiply and tell me the values?
Yes.
That means 3 lakh, the 70,000 into 0.833. What you're getting, you just tell me, add up those and subtract 5 lakhs and tell me what is your NPV. Right? I'm
Okay.
waiting. Yeah.
30,000 plus 40,000 into 0.83.
Sorry?
30,000 plus 40,000 into 0.83.
Yeah.
Last one 0.403407.
Sorry. 0.402.
Hello.
Yeah,
Hello.
yeah. I'm waiting. Yes.
16,530.
Done. Right? Shall we move forward?
Yes.
The IRR on an investment. Can you just tell me the answer for this?
A hurdle rate.
No, no, no. No. How come it usually coincides with the hurdle rate?
We'll see in some, sir.
No, I can say may produce different rankings from NPV method on mutually exclusive projects. Why? We already discussed, right? NPV, it says that the funds can be reinvested at required rate
Rate
of
of
return.
return. Yeah.
And IRR says that the fund should be reinvested at,
IRR.
they will give different answers, right?
Yes.
Coincidentally, if a hurdle rate is equal to IRR, then that can be only one of the points, but that is not always possible, correct?
Yes. Okay.
Which of the following best describes a cash flow pattern that may result in multiple IRRs for a single project? I can say, see, if you have positive cash flows and negative cash flows during the lifetime of the project, then you can have a problem of multiple IRR, right?
Yes.
You will get two IRRs. So the
Mm.
direction of cash flow changes multiple times during the life of a project. If that happens, then there is a problem of multiple IRR, correct? Shall we move forward?
Well, okay.
See, more or less declining, or see, more sometimes, less time, sometimes is not a problem.
Mm.
Positive, negative cash flows in a project is a problem.
Here in D, higher and decline is there.
See, I
Means
said
positive.
higher and decline is not a problem. Positive and negative is a problem.
Okay. Okay.
That's what direction. Yeah, just a second, just a second. Hello. Yeah. Can we go for the next question?
A.
IRR is
E.
the dash.
Present value is equal to 0. A.
Yes. Rate of interest for which your NPV is 0. Absolutely right. Next question. 13th one. Yesterday there was a lot of interruption in the class due to power cut and all.
Yes.
Which of the following statements is most likely correct for a project costing 50,000 and returning 14,000 per year for 5 years? For that, what you need to do is you need to first find out the NPV and check the clarity. Hello?
Yes, sir.
To
Hello.
rule out this and this, you need to find out the NPV. Or else what we can do, which of the following statements is most likely correct for a project costing 50,000, returning 14,000 per year for. So this is what you're investing. And 14,000 you're getting every year, right? For 5 years, correct? So that's making around how much? 70,000, correct?
Okay. Yes.
So if at all, let's say if I take any, because they did not give me discount rates, right?
Mm.
For NPV they have just given the values. Did they give the discount factor?
No.
So how will I understand whether it is 20 is 34 36,274 or 20,000? If I assume any discount factor, let's say 10%. Let's say if I take 5%, can you tell me the 5% present value annuity factor at the rate of 5% for 5 years? Can you tell me what is that?
4.329.
Sorry.
4.329.
So what is the, if you multiply this, what we are getting?
Uh, 60,606.
50,000.
60,606.
We are getting a negative NPV. Can you tell me for 10%?
For 10%, 5 years. 3.791.
For 10%.
Yes.
For 2%?
For 2%, 4.713.
That too 4.7 is going to be 61, 62. What about 1%?
4.853.
That means we are nowhere getting any value like which is going to be, in the sense, what we are seeing is for 1% also. What did you say?
So 1% it's 4.853.
Can you multiply and tell me this value?
67,942.
60.
7,942.
So if I take any factor, see, one is the least factor, right?
Yes.
Above one, the discount factors are more discounting, less inflows, less discounting, more inflows. So the highest I can get is 67. So 67 minus 50 is 17,000. So I'm getting NPV anytime less than 20, right?
Yes.
So this is not the answer. This is not the answer. These two are not applicable. Now IRR is greater than 10%, IRR is equal to 1.4%. That we need to ensure. So what we understood is 70,000 is the total inflows undiscounted, right?
Yes.
20,000 is however we are get like less than 20,000 only.
Mm.
So the return in the first year
14,000.
is 14,000. How much this is of the initial investment?
50. 50.
How much percent?
28%.
So since this is the first year only, right? So first year itself, what we are seeing is the return what we are getting on our investment is 28%. So every year we are getting 14. It's going to be more than, it's going to be higher returns or lower returns in the future now. 28.
Higher.
So that is going to be more than 10%, right?
Yes.
That's it. Shall we move forward?
Okay.
Or you want to note it down?
By seeing percentage, we should assume.
Sorry.
By seeing the percentage, the 28%, we should.
Yeah. Yes. Absolutely right. Question number 14. So a power plant estimates that cost to decommission its nuclear power plant in today's dollars is $500 million. This is not commissioning, this is decommissioning. This cost is expected to increase by 5% per year over the life of the plant. Power plant must collect a constant amount each year for customers over the remaining 20-year life of the plant, and then again place the amounts in a fund that is expected to earn 7% returns per year. The fund currently has a balance of this much, $100 million. How much must the plant collect from customers each of the next 20 years to cover the decommissioning costs? Ignore income tax effects and round to millions. This is a very typical question. Okay. So first and foremost thing is, you are like having all the information in this. How much? See, they are clearly asking, they are decommissioning a nuclear power plant, right? Whose value today is this much.
500 million.
That is going to, the cost is expected to escalate 5% per year over the life of the plant. Every year, 5% is the increment in the expenditure. And the power plant is going to collect a constant amount from customers over 20 years. The expenses in cost is increasing, but the cash what they are collecting is constant. And then they want to invest that amount in a fund, which is going to give them 7% per year. Fund balance is 100 million. How much they should collect from customers each of the next 20 years? They are asking you the amount, the payment, right?
Yeah.
So what we will do, first we will take up something. We will see this 500 million what we have, the decommissioning cost, right? It's going to increase by 5% every year, right?
Yes.
So into 1.05 whole power 20 will do. Can you tell me what's the answer?
Uh, 1326.64. 0.64.
0.64. No, whole power 20. This is 500 million. So we'll write in zeros. Right?
502.65.
This is 5 million, no? 500 million. So 500 million. Yeah, 1326 you told, right? Okay, we will 0.4, right? We'll keep it 1326. No problem to keep it simpler. Now, this is what is the cost going to be, correct?
Yeah.
Now 100 million is what is there in the fund. It is going to grow by 7% because every year it is going to give 7% returns, right?
Yes.
1.07 whole power 20. Can you tell me how much is this?
386.9.
I'll take 387. So now this is the increment in the expenditure. This is the like returns. So can I say net is the savings,
Yes.
right?
Here 20 is 20 years life. Okay, for
Yeah,
both
20
we have
years.
taken 20. Okay.
Yeah. So we are seeing that we are getting the returns one is 387 and the expenditure one is 3026. So we need to raise how much more? Can you tell me the difference? 3026 minus 387.
936.
So this much need to,
939.
yeah, 939. This much need to be raised, right?
Yes.
So 939 is to be raised because our expenses are going to be this. Our fund is going to give us the balance, which is going to be after 20 years is going to be this much in the fund. This much is the expenditure after 20 years, right? So this
Yes.
much is to be raised to fill the gap, correct?
Yes.
Now what we need to see is you need to find out the factor. What do you need to find out?
Factor.
Factor. See, so you have to go to the future value table to find out the present value of 20 equal payments. Okay, that will accumulate 939 in 20 years at the rate of 7%, right? Correct?
Yes.
Because this is the return we are expecting from the question, right?
Yes. 7% 20
So we
years.
need to get the future value factor for this 939. We need to get the future value factor to understand how much they're asking, right? The fund currently has a balance of this. How much must the power plant collect from customers each of the next 20 years? So every year, how much they should collect, correct? So
Yes.
that they can bridge this gap of 939. So 939 divided by the future value factor. Why I'm not taking present value factor? Because this is
Next.
for the future,
Yes.
right?
Yes.
Future or present?
Future. Next 20 years in future.
Yeah. So every year, how much they should collect for the next 20 years? So factor at the rate of 7% for 20 years. Can you tell me what is that? It's simple, right? It's present value is nothing but for today. We are seeing for the future. Now, next. Can you just find out and tell on the table?
In table we have only present value.
Future value of annuity is also there, right? Shall we calculate with the formula then?
Yes, sir.
So just put the future value of annuity formula. I have given the formula, right?
1 divided by.
Sorry, I'm writing. Okay. So it is 1 plus r whole power n minus 1 by r. 1 plus 0.07 whole power 20 minus 1 by 0.07. Can you tell me what is this?
40.995.
40.99. Just divide this 40.99 with this, you'll get the answer. Actually, in CFA course, we have calculators for this, finance calculators, whereby we directly put this in those calculator and function and we directly get the answers. But here in CMA, Don't know, they don't usually use. So 939 divided by 40.99, 22.9 it seems. So 23, correct?
Yes.
So this much every year will become 939 in 20 years, right?
Okay.
So are you noting down this one?
Just a minute.
Okay.
Done, sir.
Okay. Next. Just do the next question. For a given investment project, the interest rate at which the PV inflows is equal to outflow. Can I say this is IRR? Suppose you have invested $100 and you have also got $100. So the difference is zero. That is NPV, right?
Mm.
The the interest rate or the cost of capital or the discount factor at which your NPV is exactly equal to zero is your IRR. NPV can only be zero when your present value of cash inflows is always equal to present value of cash
Outflow.
outflow or the cash outflow. Present value need not say, because on that day that's the only present value. So answer is IRR. I expected this answer from you. Okay, next one. So this is the question which I would like you to do, because this is a NPV question. Okay, shall I give the time?
Yes, sir.
Okay.
Can you scroll it down, sir?
Yeah. Shall I explain or doing?
Doing so here for in first year it's negative, so tax after tax also its value will be negative only.
Just a second. See, they're asking you to find out NPV, right?
Yes.
So you are having all the cash flows. This is the outflow, right? So you have to take the discount factors. What is the discount factor here? Management anticipates that the equipment will be sold at the beginning of year 6 for this much when its book value is 0. IRR and effective tax rates are given to you. So what will be your discount factor like? It's given, right? Your internal
Tax rate is
hurdle.
for internal hurdle
That's
rate is
not
for.
IRR, that is internal hurdle. That is the discount factor, hurdle rate, right?
Yes.
It's not IRR. So I just purposefully told you to confuse you, but you did not say that it's internal hurdle, but at last you realized.
I-
So, no, no, you realize.
mm,
Yeah, so like tax rates are given. So
I
we need,
deducted 40
yeah,
0.0
we
from
can,
cash flows.
yeah, we can do that.
Mm.
You deducted all these cash flows with
Yes.
their taxes, right?
Yes. Yes. After that, then discounted rate 14%.
Yeah, so we need to like after tax disposal proceeds are discounted at the fifth year because it occurs at the year 6. So in fifth year you have to, like, what happens is in sixth year also we have to consider the sixth year. Why we need to consider the sixth year? Because related this particular transaction, what is there is related transaction. See, what happened is when did they dispose? They disposed at the beginning of year 6, which is nothing but end of year 5, considered like that, right?
Yes.
So I will not say year 6, you can write it here only, 50,000, correct?
Okay.
And just a second. Yeah, hello, hello.
Yes. Yes, sir.
So yeah, so all the after-tax cash flows, this is outflow. All the after-tax cash flows are clearly given. So the only one we need to adjust is the 50,000 sale of asset. 1 minus 0.40 we will do. Okay. And let us discount this. So discount is at the rate of 14. How much is that? This right? 14%, right? Yeah.
14%. Mm.
So we will take the factors. So it's 0.877,
8,
right? 0.769,
7,
0.675, 0.592,
20, 0.5193.
0.519. So just can you find out the NPV and tell me, please? I'm just waiting.
In fifth year only you have deducted tax. Other 4 years?
No, these are all after-tax cash flows.
Okay.
You have to be very cautious while doing the questions. Many students know all the concepts. They just like kind of, if you're not that alert, right, gone.
Mm. Yes.
And one more, the biggest thing what these people do is they trick you. They give you four options of that kind only. That means one option which you are getting, right, without
Mm.
considering after tax cash flows, and the NPV what you're going to get is going to be in the answer option.
Okay, we'll select that answer.
Yeah, then we will by mistake select that answer. So we have to be very cautious. How can we find out?
Yes, sir.
Yeah, I'm waiting. Okay. Just calculate. I'm coming in 2 minutes. What's the answer?
Um, 78,690
Sorry.
minus 7,86,080.
Yeah, so that is 1780 something, right?
Mm.
Okay, that's the answer. Next question. 17.
B.
Yes, absolutely right. That we have already discussed. This is
Yes.
the next question, 18th one. Yeah. If you want, I will just scroll down for more data.
Okay. Estimated.
So this kind of question, you have to first find out the NPV before change. And then you have to find out the NPV after change. And then you have to see the difference in that, right?
Yes.
Shall we do this? It's a good question. It's a big question. I'm solving this. Please try to understand. So first we will see without sale NPV without sales increase. Then NPV with sales increase. Okay. Now, so we are going to take sales minus variable cost. That is going to give us the income, right?
Yes.
So yeah, 5,000 units into 1,000 minus 500, 5,000 into 500. So this is like 50 minus 25. I will take like this. So 25. See, I'm not taking all the figures. I'm just taking like this, right?
Okay.
And the tax on this we will take. What is the tax rate? 25%.
25%.
Yeah. So we are going to take only like 75% of this.
0.75.
0.75. How much is that? Can you tell?
18,75,000.
18.75, right? And then depreciation tax shield. So investment is 10 lakhs, it seems, divided by 10, whatever you're getting, into tax rate 25%. So I think, so 2 lakh,
20.
2 lakh
2,50,000.
50,000, yeah. So 2.5 I will take. Right. So 21.25, right?
Yes.
Yeah. Now this is for how many years? 10 years, right? So present value annuity factor at the rate of 10 years at 12%. What is the form? Can you tell me the factor?
12%, 10 years. 5.650.
So can you just multiply and tell? 21.25 into 5.650. I'll put it here.
21.25.
120 something you'll get, right?
120.06.
Yeah, 120 point something, right? So the investment is 100, right? So 20
20.
something I get, right? This is my NPV.
Okay.
Now, next thing what you have to do, you have to just increase the sales volume. If you increase the sales volume, your variable cost will also increase, right? By
Yes.
10%. So
10%.
say, yeah, so sales, if I took here 10%, 10% of this will be 55, right? and 10% of this is 2.5. So 2.5, 25.0, 2.5, 27.5, right?
Yes.
And rest of the things are same only now. Nothing to worry, nothing to see about. Can you do this? Only these two will change. Others are all same. What's the difference you will be getting here?
27.5.
27.5. And tax also you have to take
0.75.
27.5 into 0.75. Yeah.
20.62.
20 point.
62.
So if I reduce the 20, yeah, so I get 20.62 directly, right?
Hmm.
And then after getting 20.62, depreciation tax shield is 2.5. How much? Have to add.
51. Add.
Yeah, yeah.
Tax shield.
Yeah, it's a saving now. It's a cash saving, right?
Hmm. 23.12.
23.12, right?
Yes.
Into 5.65, 0. How much?
130.62.
130.6, right?
Hmm.
100 if I take out, it is
30.
30.6. So 31. 31 minus 20 is 11, right?
Yes.
Okay. Can I say the answer is around D?
Hmm.
Correct?
Yes. Approximately.
Right?
Yes, sir.
Hello?
Yes, sir.
Yeah. So do you want to note it down?
Yes, sir.
Okay.
Scroll down, sir. 30.6 is without sales.
Yeah,
And
this is like
20 is
increased sale NPV
20 is
before increment NPV.
if
Difference.
okay.
10.6 is approximately 10.59, right?
Yes. Yes, sir. Okay. Done, sir.
Yeah. So what is the next question?
Acquisition. 18.
Yeah, we are going to, yeah. So just read this. So in order to increase production capacity, gunning industries is considering replacing an existing production machine with new technologically improved machine effective January 1st. The following information is being considered by gunning industries. The new machine would be purchased for this in cash. Shipping, installation and testing would cost an additional 30. Okay, new machine will be purchased for the given price and all these things would cost this much. New machine is expected to increase annual sales by this much. This is relevant information for us. And at sale price of 40, incremental costs are also going to be seen. Investment in new machine will require an immediate increase in working capital also. And they are going to recover it in 5 years, it seems. After 5 years. Gunning uses this straight line depreciation for reporting purposes, tax reporting. New machine useful life is this. Gunning is subjected to 40% corporate income tax rate. Gunning uses the NPV method to analyze investments and will employ the following factors and rates. Present values, present value of ordinary annuity, everything is given. But what are they asking actually? The acquisition of new production machine by gunning industries will contribute a discounted net of tax contribution margin of. So we are only concerned about contribution margin. So sales minus variable cost is contribution, right? You know this.
Yes, sir.
So here the information about everything is not clear, but some information is the sales is going to increase by 20,000, right?
Yes.
And the selling price and the variable cost is also given. So 20,000 into 40 minus 30, that is sales
10.
minus variable cost is contribution, right?
Mm.
So it's going to be 2 lakhs, right?
2 lakhs. Yes.
This 2 lakhs is going to be every year or not? Yes, it is for 5 years, they said, right? Hello.
Yes, sir.
This is for how many years? 5 years. So
5
we will
years.
take this after tax. We will take this after tax into 0.60 because tax rate is given 120,000. This 120,000 we are going to see for the next 5 years. So annuity factor at the rate of, they have given the annuity factor also at the rate of 10%, that is
5 years.
3.791. Just multiply this and tell me we'll get the answer. Simple question, just sorry.
4,54,920.
Yeah, 4,54,920. Absolutely right. Okay.
The question is lengthy. Yes, sir. I'll note.
Yeah, okay.
Done, sir.
Next question. Company is in the process of evaluating a major project line expansion using a 14% discount rate. The firm has calculated the present value of both the project's cash inflows and outflows to be 15.8 million. Present value of both the projects cash inflows and both the projects are having same. Okay. So then what is happening? Both the projects are giving the same kind of inflows. Both projects cash inflows and outflows, and they are saying 15.8. Company will likely evaluate this project further by. I think this looks more relevant comparing the IRR versus the cost of capital and hurdle rate, right? They'll compare everything, right?
Yes.
Because IRR is like the discount factor at which NPV is equal to 0, right?
Yes, sir. Right.
And that is only the discount rate. That only becomes the discount rate, right?
Yeah.
And whether the project is like with a certain IRR is acceptable, this return you have to compare with the hurdle rate again, or current cost of capital, more or less. Yesterday only we discussed that
Yes.
concept, right?
Yeah.
Yeah. Next question. One
Disadvantage.
disadvantage of using the IRR is that, of course, may not be used when cash flows vary from positive to negative because you have MIRR problem, multiple internal rate of return, right?
Right. Yes, sir. We discussed.
Yeah, we discussed already. 22nd question.
Corporation has an
Again, the same kind of question only.
B. IRR in addition.
Yeah. So multiple IRR problem. So project has another IRR in addition to 16%, right? Right? Why? Because negative and positive cash
First.
flows are there.
Yes.
Yeah. 23rd question. Which mutually exclusive project would you select if both are priced at $1,000 and your discount rate is 14%? Project A with 3 annual cash flows of like $1,000. Project B with 3 years of zero cash flow followed by 3 years of 1,500 annually. Which one you will see? You will see the NPV, which one is higher, right?
Hmm.
So can you calculate the NPV for these two projects and compare? Shall I wait?
Yes, sir.
Okay. So shall I do?
A. I got negative NPV for project A.
Let's check. So you have taken the $1,000 so into present value annuity factor at the rate of
10.
14%, right?
14%. Yes.
For 3 years.
3
What is the
years.
present value factor?
0.6749.
No, that is discount factor. I'm saying present value annuity factor for 3 years.
2.322.
Yeah, so 2.32. So it is 2322, right?
Mm.
You have invested $1,000. That is the outflow. So what is your NPV? 1322.
22.
Project A. Now project B. 1,500 you are going to get, right?
Yes.
But you're going to get in the last 3 years. First 3 years it is zero, right?
Yeah.
So with 3 years zero flow followed by 3 years. So you have to take annuity factor for 6 years. What is that?
6
But
years.
but but but
14%.
but it is not like that. Yeah. What is the 6 years factor? Please tell me. Present. Yeah. Present
3.889.
value annuity factor at the rate of 14% for 6 years minus present value annuity factor at the rate of 14% for 3 years, right?
Yes.
1 to 3 years, if you take 6 years minus 1 to 3 years will give you 3 to 6 years, right?
Mm.
Value annuity factor at the rate of 14% for 3 to 6 years. Am I right or wrong?
Yes, sir. Right.
So from the total 6 years, if I remove 1 to 3 years, I get 3 to 6 years. So can you tell me the difference? 3 point, what did you say?
889.
3.889
889.
minus 2.322, right?
Yeah.
Can you tell me the answer?
1.567.
1500 into 1.567. So what's the answer here?
23,505.
So again, I'm removing 1000 my investment. I'm getting
Why
1350 because
1,500,
that's
no?
the investment, no?
Okay.
That is common for both the projects, right? So this
Right.
is having higher NPV than this one. So can we select this project
D.
D?
Yes.
Yeah. So 24th question also, can I give homework or shall we do now?
Discounted cash flow. I'll try, sir.
Yeah. If you're not getting, we will do.
I'll take.
25th.
Mm.
So the management of a company is considering how to invest 15 million. Possible internal investment choices are following projects with similar risk. A, B, C, D and IRRs are given. Company can also invest up to 15 million into an external project in equivalent risk to internal projects and earn 10%. How should the management of the company invest this 15 million in order to maximize the value of the company? They're asking. This also you can do as homework. You can try.
Okay.
Shall I give this?
Yes, sir.
Or you want me to do? I'll do.
I'll try. If I get any doubt, I'll text you.
So we will do one thing then. This till 25th we have tried. We will target next 25 questions in the next class.
Okay.
It's a time consuming process, this especially this chapter. Okay, the questions are very big. So in this time we would have done 30 plus questions in 30 40 30 plus in
Yes.
ratios, but in
Right.
this chapter it's like very big. Every question we are covering till now we have covered 23 and 2 I'm giving you as homework. I've covered 23 questions till now, right? If
Yes, sir.
these two you are not getting, we will solve in the next session and we'll go for the next 25. So 50, I will set the platform. There are 117 questions, right?
Yes, sir.
I will do almost 50% of this, like 60 I will cover up and then I'll give the rest of the questions to you. Okay.
Okay. Okay, sir.
Okay, Samran. I'll see if any of the days I'm having any free day, I'll just message you and take the class.
Okay, sir.
Okay, Samran.
Okay.
Thank you so much. Thank you. Thank you.